Every day, millions of corporate transactions across global industries, from heavy manufacturing to software development, businesses generate an endless stream of raw financial data. Left in this raw state, this flood of information is completely impenetrable. Without a standardized way to organize and present these figures, capital markets cannot function. Investors have no reliable way to evaluate the health of these companies or compare their performance. International Accounting Standard 1, or IAS 1, acts as the architectural blueprint designed specifically to solve this structural chaos. While other IFRS standards dictate how to measure financial value, such as calculating depreciation or recognizing revenue, IAS 1 serves a distinct purpose. It dictates exactly how that measured value must be presented to the outside world. The standard's core objective is twofold. First, it guarantees inter-period consistency, meaning a company's financial story tracks logically from one year to the next. Second, it enforces inter-entity comparability across the globe, allowing analysts to place entirely different companies side by side. To achieve this, IAS 1 regulates the creation of general-purpose financial statements. These are structured representations built specifically for primary users, investors, lenders, and creditors, who lack the authority to demand tailored internal reports for management. Because these users must rely entirely on published reports, comparability is the foundation of capital allocation. It is the mechanism that allows an investor to fairly judge a tech firm in Tokyo against one in Berlin. This blueprint shows the foundational layer of IAS 1. It acts as a rules engine that filters all corporate transactions before they reach the final statements. The first rule in this engine is the assumption of a going concern. Management is strictly mandated to assess the entity's ability to survive and continue trading for at least the next 12 months. If there are material uncertainties about the company's survival, they must be explicitly disclosed. The second rule requires the use of the accrual basis of accounting. Items must be recognized as assets, liabilities, equity, income, and expenses when they satisfy specific definitions, regardless of when cash changes hands. The single exception to this rule is the statement of cash flows. The engine also enforces a strict threshold for materiality. Information is material if omitting or misstating it could influence the decisions of primary users. IAS 1 expands this definition beyond simple omissions. The standard treats the act of obscuring material information as a direct violation of fair presentation. This illustrates the presentation trap. Burying material facts within immaterial text hides economic reality. If an investor cannot locate risk factors surrounded by trivial data, the standard is breached. IAS 1 forces preparers to isolate and highlight material data so users can identify relevant figures. These bedrock axioms force management to present an unvarnished reality. Instead of a technically accurate but practically useless data dump, users receive a functional assessment of the entity. Within this presentation framework lies a strictly enforced structural rule, the offsetting prohibition. Entities are forbidden from offsetting assets against liabilities or income against expenses. They must report both sides of the ledger separately. There is a singular exception to this mandate. Offsetting is only permitted if it reflects the true economic substance of a transaction, or if required by another IFRS standard. This diagram demonstrates the mechanical risk of offsetting. If a company has massive accounts receivable and equally massive accounts payable, merging them into a single net figure hides the true scale of the company's obligations. Forcing gross presentation protects the user's ability to accurately assess the entity's liquidity constraints. It reveals the actual magnitude of future cash flow risks that a netted figure would completely conceal. With the rules engine set, we examine the first of the 5 required pillars, the Statement of Financial Position. IAS 1 dictates a list of mandatory minimum line items that must appear here. This includes property, plant and equipment, inventories, trade receivables, and provisions, ensuring baseline detail. The standard also governs how these items are grouped, enforcing a mandatory split between current and non-current assets and liabilities. Items are classified as current based on their relationship to the normal operating cycle, the time to acquire assets for processing and turn them into cash. This timeline tracks an asset routing through that operating cycle. If the asset is expected to be consumed within this cycle, it sorts into the current bin. If the cycle is unidentifiable, the threshold defaults to 12 months. Everything else is classified as non-current. There is a specific liquidity exception for some entities. Financial institutions, which do not produce physical goods, are allowed to present items purely by order of liquidity, provided it yields more relevant information. This current and non-current split transforms a static list of assets into a time-bound map. It allows users to immediately distinguish near-term working capital and solvency from the long-term capital structure. Next are the dual pillars of financial performance: profit or loss and other comprehensive income, or OCI. Entities can present a single statement of comprehensive income divided into two continuous sections or two separate sequential statements. Within the profit or loss section, IAS 1 mandates that management subclassify expenses to provide the most reliable and relevant information possible. The first option is the nature of expense method. This aggregates costs by what they inherently are, like depreciation or raw materials, without reallocating them. The second option is the function of expense method, categorizing costs by their role, such as cost of sales. If chosen, entities must still disclose specific nature data, such as depreciation, in the accompanying notes. Beyond the standard profit and loss, the standard dictates the mechanics of other comprehensive income. OCI captures items of income and expense explicitly excluded from profit and loss by other IFRS standards. Core examples include unrealized gains from property revaluation surpluses or gains and losses from translating foreign operations. This creates a mathematical risk. When unrealized gains in OCI become realized, they must be recognized in profit or loss. If the numbers aren't handled correctly, the entity will double count the same income across two different periods. This diagram shows the mechanical solution: reclassification adjustments. As the realized gain moves into the profit or loss ledger, a simultaneous deduction is triggered in the OCI column to maintain balance. Isolating OCI and managing these reclassifications prevents temporary, unrealized market fluctuations from distorting the view of the entity's core operational profitability. The fourth pillar is the statement of changes in equity. This serves as the reconciliation engine, bridging the net assets from the beginning of the reporting period to the end. This statement isolates transactions with owners in their capacity as owners. It strips out actions like issuing shares, buying back equity instruments, and distributing dividends, keeping them separated from comprehensive income. Finally, we arrive at the fifth and qualitative pillar of the complete set, the notes. While the notes are sometimes treated as an appendix, IAS 1 makes them a required component. They provide the specific qualitative detail necessary to understand the quantitative totals in the primary statements. The notes must contain an explicit statement of compliance with IFRS. They must also define the specific measurement bases used to prepare the statements, dictating whether assets are recorded at historical cost, fair value, or net realizable value. This visual highlights a critical disclosure requirement. Management must explicitly outline the subjective judgments they made when applying accounting policies. They must also detail specific sources of estimation uncertainty regarding future asset carrying amounts, laying bare the assumptions they made about an unknown future. By quantifying the subjectivity inherent in accounting, the notes allow analysts to accurately price the risk hiding behind the hard numbers. The complete set of financial statements operates as an integrated ecosystem where every component relies on the others. This diagram displays all 5 pillars presented with equal prominence. Every numerical item on the primary statements must cross-reference directly to its explanation in the notes. Additionally, IAS 1 requires management to add specific subclassifications to enhance user understanding. IAS 1 does not force every business into a rigid generic template. Instead, it establishes a minimum threshold of transparency, adapting to the complexity of the entity while preserving the core structure. By standardizing presentation, IAS 1 ensures an entity's financial architecture speaks a unified, transparent language to global capital markets, regardless of geography or complexity.